disruption in wealth will probably happen, but we don't see that happening soon. And obviously, we will be able to convert a business model as and when it happens. Today, it's working really well for us. It is that we'll keep on innovating in the future. We'll keep on coming up with new stuff. We'll keep on being the first ones in the industry to do things. Fintechs have made it very easy to access, I think, products. I think access has been disrupted. So if your business model is based on access, then yes, that is a space where you really won't make any money. And what we've seen over the course of at least history, or at least the last 20, 30 years, the people who really made money have actually made money of ownership. And I do believe that over the next 10 to 15 years time, as more and more people sort of go into the stock market, they really want simple solutions, for their investments.
Everyone, welcome to another episode of Talks with Daulat, where we aim to deconstruct the seemingly complex world of finance and empower investors to take better and relevant investment decisions for themselves. My name is Varun Fatehpuria, and I am the founder and CEO of Daulat Wealth Management. Today, we have someone whose family has been deeply involved with the Indian capital markets over the last 3 decades and is often seen as a pioneer in whatever it does, the Motilal Oswal Group. Motilal Oswal was founded in 1987 by Mr. Motilal Oswal and Ramdev Agarwal. What started out as a small sub-broking business by two individuals have really grown on to become a full-fledged, full-service financial services firm in India, catering to investors all across the country, across a wide range of products such as retail broking, distribution, asset and wealth management, etc. Please join me in welcoming Mr. Pratik Oswal from the Motilal Oswal Group on the show today. Pratik, it is an absolute pleasure to have you on our show. Pratik heads,
No, go ahead, please.
Pratik heads the passive business at Motilal Oswal Mutual Fund and is responsible for its Index Fund and ETF product line. If all of those things sound a bit confusing to you, we'll just get a bit more into detail shortly. Pratik holds a bachelor's degree in economics and mathematics from Emory University in the United States and a master's in business administration from the London Business School. So, Pratik, let's get started by understanding your own journey into the space. I think it's fairly obvious from the outside looking in. You grew up with talks about finance, about the share market. So, how did you, I would say, as an individual, really decide to pursue a career in finance? Because, again, this can be a pretty cutthroat industry, and unless you're really passionate about it, I think it's really difficult for you to see it through the entire length of journey. So, what was your sort of like guiding light when you got started, and your advice from your father when you want to enter this industry?
Yeah, thanks Varun for having me out here. Looking forward to our chat today. Honestly, it's a very interesting question because I think for me, surprisingly, I did not have a lot of dinner table conversations about work and finance and stock market and shares and all that, which is surprising. I think my dad and mom always kept things very personal at home. I think it's and I sort of do that in some way today, where I'm at work, when I'm at home, so I don't tend to sort of mix the two. So I do think that the interest came from more about you're always inquisitive about what your dad does, or how he spends his time, and you always sort of like to go to office and spend time there and sit there and all of that. So I think spending more time with him, because obviously he's worked extremely hard, so we've all been there for him wherever. So I think interest levels came from his interest levels, and then also one of the best I would say habits that I've developed over the last 20 years, 25 years has been of reading. I picked up my first stock market book when I was maybe 11 or 12. And I think I've read hundreds of books over the course, and especially a lot of them in my sort of teens, and that has really inculcated an interest in this space. And honestly, it hasn't stopped. So I do believe that even though I have interest in many things, I think finance is one thing where I've been consistently interested since I was maybe 15, 16, 17. So I think and knowledge is also compounding. So it's always good to be interested in something for a very long time, and actually it's helped also in a very big way. So I think reading up a lot, genuinely interested. Like honestly, finance is quite boring. it's quite nerdy. And to be able to, read finance books at 16, 17 is like the nerdiest thing you could do. So the fact that I liked it meant that, maybe there's something there. And that's how it started.
One of the biggest things, Pratik, that has stuck to me, honestly, personally, is that despite working in such a big organization with a very well established processes and systems, and sometimes it can really, prove difficult to move the needle, so to speak, right? But I think what we have seen specifically with you over the past few years, you have really carved out your own niche, right? I mean, you have not really been there that he is the founder's son and automatically he gets the high seat at the table, right? Over the past few years, we have really seen you sort of like, develop your own niche and really take it one step at a time. And now currently you're heading, I would say, a relatively bigger portion of the business. But I think from the outside, again, it tends to be a smaller part, right? So what was, again, I would say I'm trying to go back because it's really interesting to understand. I mean, the kind of advice that you would have received early on in your career, that not to think of yourself as the founder's son or the founding family member, and really trying to prove your mark in whatever you're doing in the organization and really trying to earn your medal, so to speak.
Yeah. So, it's I always thought of the company as a professionally managed company. The only family member that's involved in this company is my father. So it's not really a family owned
Yeah.
company where I have uncles and cousins and all of that. And also, it's not really it's actually owned by two people, not one. So actually, it's more of a partnership than it's really like a founder owned and controlled company. So I do think that I've been told at a very young age that obviously you have to work hard and you have to ultimately, I think even though you've been I think the professional mindset is very important. The good thing about me is that the professional mindset, in addition to an ownership mindset, that is a very good sort of I think combination to have, and hopefully I'll be able to exploit that combination going forward. But yeah, I think super professional. My idea is to just be useful. To be honest, I saw it from the outside, and I was like, how can I make things better? How do I be useful in this ecosystem? I also thought that my mindset, my thought process is slightly different from what it is as a company. So obviously I'm still adjusting to the company. It's still tough. There is obviously a lot of layers and all of that in the system, and sometimes getting away is tough. And I don't really force my way. So I do think that yes, by having this separate vertical that I carved out about 4 years ago, well, two of them now, three of them, that's really helped me gain interest, sort of create my own ecosystem, and also it's sort of adding value to the sort of organization as a whole. But yes, I think it's not really something which I see full time. Over time I'll have to obviously make sure that I'm sort of more on part of the system, which hopefully I will in the next few years. But I think for now it's been a great start. It's been a super fun start because I've been able to really, like, I mean, people have entrusted me with a lot of stuff, and I think, and so far, it's been a lot of fun.
Great, great, Pratik. I think I think that kind of sort of like humility is something that's really sort of like comes across in your conversations, and the approach with which honestly the organization is also run, and I've also sort of seen your father interact with a lot of people with that sort of like a care. But talking just a bit more specifically about the line of business that you're currently handling right now, like the passive business. So, for the benefit of our audience, could you just tell the difference between the active and the passive style of investing, both, let's say, across equities or debts, if you want to call it, and what are the similarities and differences between them?
Yeah, absolutely. So, when it comes to investing, and this is a very bird's eye view of investing, you basically want to promote ownership. I think the best way to create wealth, there's two ways of making money. One is through owning something, and the other one is through renting your time through a salary or something like that. And what we've seen over the course of at least history, or at least the last 20, 30 years, the people who really made money have actually made money of ownership, on owning things. Even uh, if it's owning their own companies, if it's owning stocks, real estate, gold, whatever it is. I think ownership is very important. And one of the best ways of owning, or at least in terms of wealth creation, is participation in equities, or the share market. So buying and selling stocks is tough. It requires a lot of expertise. So mutual funds make it very easy towards, I think buying stocks. You hold a portfolio of stocks, so you're not exposed to the daily volatility that comes with the stock market, and it's much easier to hold on to your investments for a very long time. Within mutual funds, I think passive funds, ETFs, and index funds make it even simpler to hold stocks. They're simple index. I'm sure a lot of people would have heard of Nifty, Sensex. So those are indexes, and the idea where index fund is to replicate the returns of the index. So if you're buying a mid cap index fund, your fund has to replicate the returns of the mid cap index fund. So the mid cap index fund is up, index is up 10%. Your return should also be around that much. So it's a very simple, straightforward way of investing. And I do believe that over the next 10 to 15 years time, as more and more people sort of go into the stock market, they really want simple solutions, for their investments. And between choosing between 50 or 60 different mid cap funds, if they can just buy the index, it's good enough for your long term portfolio. If you're looking to invest for say 25, 30 years, then it's very hard for you to select one fund. So buy the index and you can hold on for a very long time. So I think index funds and ETFs are a category which is very popular globally. And when I saw in 2018, so I was actually a wealth manager. So I was in your shoes about 5 years ago. And I saw that, and this was in the US, and I saw that most portfolios in the US had some index, some ETFs, some active funds, some quant funds, and when I came back to India, I realized that nothing was there. I think there was only these, these long only active funds, managed funds which were there. And I thought that, India tends to trail the US a lot in a very big way. So it makes sense for me to get involved here. And it's also a, sort of an area which we've already dabbled in the past. In fact, MOMC, Motilal Oswal AMC was a passive ETF sort of AMC back in 2009. So we've already sort of had experiences. We failed once. So this is our sort of second time around. So that's how we started sort of this business back in 2019, and so far it's been great. We've grown significantly, and we have a lot of funds now under our belt. We're one of the largest in this space in terms of number of funds, and also I think we're coming up with more and more innovative funds every day.
And this focus on passive, Pratik, right? Was it more of a deliberate call going where the puck is headed, right? Because this is again an approach that we have seen being fairly popular in the West, right? I think a lot of people in the United States, as you correctly point out, we try and replicate them. And obviously, where the West is with respect to their own trajectory in the capital market cycle, right? I mean, it's a lot more mature market. So obviously, the scope for alpha generation tends to be significant less over there because again all the information is typically very well priced in. I think as an emerging market in India, I think obviously there could be an opportunity for both of these approaches to sit side by side. But why do you think the AMC and you guys have focused so heavily on the passive, given again there is an ample headway and room to grow on the active side?
So actually, our core business is still active funds, managed funds. Passive is still a very small piece. The active tends to be more of an HNI business, B2B business, whereas passive tends to be more B2C. So what people see is passive because the distribution is more direct to consumer, whereas the active piece is more ultra HNIs and also B2B. But that is still a core business. I think if you look at our overall AUM of say 55,000 crore, still passive is just 15,000 crore out of that. So I think overall we're still sort of and obviously there's ample of I think opportunity out there. So I think both sides are basically meaningful over the long run. I think both sides will have a lot of success. You will see that in the US, for example, a lot of the active money has actually left the mutual fund industry and gone outside towards alternatives. Whereas you're seeing a similar shift in India, where a lot of the people who want sort of like the HNIs, ultra HNIs are going towards these sophisticated alternative products, which is where we're seeing active money going. So I think there will be ample of sort of opportunity at both ends. On the passive side, to be honest, it's more about simplification. In fact, I one of the reasons to why we got into this is because I actually, when I came back to India, I wanted to set up a technology company that does asset allocation. Very simple, like a robo advisor sort of a thing, and that required building blocks. That required a mid cap fund, a small cap fund, an international fund, and I actually didn't have the building blocks then. So I was like, what? Let me just launch them myself and then add them to the robo advisor. The robo advisor obviously has not scaled up, but the passive business has scaled up. So I think that's how it initially started. But the idea was very simple: is to have building blocks for asset allocation. We believe that asset allocation is key for wealth creation, not really fund selection. And with a passive fund, it's very easy for you to just I think we have 28 funds across all categories. So anyone who wants international fund or a gold fund or a mid cap fund or whatever fund, they can just add it to the portfolio in a very simple way. So that
So
was
when
the
we
initial.
yeah when you go and speak to a lot of these investors today in the country, pretty much spread through the length and the breadth, I think there's definitely a lot of literature surrounding, whether you should be doing active and passive and all of those things. I mean, there's just so much information that is being floating around, right? Investors often gets confused that, it's an either this or a that approach, right? Either I should be doing active or I should be doing passive, right? What would your advice to be investors to how should they basically reconcile both of these approaches of investing, and what role each of those play in an individual's overall investment portfolio?
Yeah, so honestly, there is no right answer, unfortunately. You can go all active, you can go all passive, you can go hybrid. I think it really depends on person to person. Active funds are equally good, to be honest. A lot of them still, deliver alpha, not at all times, but they do. So I think for someone who wants to, bet their money on a certain fund manager and their sort of, value proposition, then it makes sense to go for an active. In fact, what we've seen is that the stickiness of an active fund is slightly higher than on a passive fund, because people always think that there's a temporary lull and people will come back. Whereas in a passive fund, because there's no one sort of behind it, churn tends to be a lot higher in passive funds. So it really depends on person to person. I think in my case, we are always proponents of a hybrid type of a thing where some of your money, say a core allocation, or something that you want to invest for say 20, 25 years, just put in a Nifty 500 fund or some index fund without even thinking about. And then if you're looking to sort of make bets for the next 3 to 5 years time, then it makes sense to go for a active fund where you have the expertise to select the fund manager. So I think for someone who's a DIY investor who doesn't want to spend time selecting, a passive only portfolio is good enough. But someone who is sort of experienced and who is able to sort of select the right fund, I think the biggest mistake that people make is trying to buy the fund which has the highest returns, and that is a really seriously big mistake, because what we've seen is that the funds that perform in the past, there's a good chance that they don't perform in the future. So I think people need to look at the overall strategy, the fund management execution, the fund house philosophy, for them to really go ahead and select the right fund. I am of the approach that it should be hybrid, but honestly, there is no right answer. It really depends on people. I think what's important is people who select the mutual fund should stick to it for a very long time. Should be disciplined about it. The average, there was this data that I saw that the average holding period of a mutual fund in India is about 1.5 years,
Yeah.
which is absolutely crazy. Which is absolutely crazy. I mean, it should be more than 5, 6, 7 years. So I think buying a mutual fund and churning it is a recipe for wealth destruction. So I do believe that most investors should do whatever is comfortable for them to hold stuff for 5, 7, 10 years minimum. So that's how the holding period should be.
And that provides a good segue to our another question that I wanted to discuss, right? Obviously, I think with respect to the holding periods that most of the investors today in India have, I think technology has played a big part, right? While at one end it has definitely made the entire investing process a lot easier, right? On the other hand, it has unfortunately given people access and tools and power to basically be able to just log on to the app and redeem it whenever they feel like, right? I think that's sort of like the friction which has gone away with technology, unfortunately, has not played really well into the investor's return, right? But trying to just zoom out a bit, your company has been here for over 3 decades. It has definitely seen a lot of the market cycles, the disruption which comes. But this growing power of fintechs over the last 5 to 10 years, right? I think, was there ever a moment in the company where it really felt that, oh no, this thing is real and this can really eat into and disrupt our traditional broking business? Because with respect to the discount brokers, I think definitely on the retail side of things, I think they've pretty much captured the market, right? So as a company, from a strategy point of view, how do you guys, rewired the company to adjust to whatever is happening in the fintech space?
Yeah, so disruption is real. I think, especially in the financial services domain, where honestly, fintech is like like now bigger than any other tech. So especially in India, I think if you also look at the profitability of every sector, if you look at just every sector, look at profits, then the highest number of profits will be generated by the banking and financial services industry. So that's where the profit pool is, and wherever the profit pools is where you have a lot of competition, you have a lot of startups coming in. So I do think that yes, fintechs have made it very easy to access. I think products. I think access has been disrupted. So if your business model is based on access, then yes, that is a space where you really won't make any money. So I do think that access to financial products, whether it's stocks or mutual funds or bonds, I think that market is, I would say, slowly becoming zero fee, just like payments. But I do feel like at Motilal Oswal, access is something which we did provide a lot over the last 3 decades. But one of the key value adds that we provide is research, is advice, is also a distribution capability. India is still primarily a push market for financial products. And this is for mutual funds, stocks, insurance, all of that, and that requires, I think, a physical infrastructure for you to go out there and, I think, go out there and actually talk about these products to customers and get customers in to buy these products. Yes, on the retail side, at least on the broking side, there's a lot of disruption for people who just want to buy and sell stock. But I think if you look at wealth management, or if you look at, say, distribution, it's still very physical, and that I think will probably be physical for the next decade or so, which is what our focus is. In fact, what we realized is over the last 5 years is that we've actually doubled down on our distribution. So if you look at our business model today, it's actually, most of our competitors have actually gone towards discount broking, whereas we stood our ground, and I think that's worked out really well. Today we're top three in terms of profitability, and maybe top 7 or 8 brokers in the country in terms of volume. So I think volume is something that we don't want to play with. We want to play in profitability, and there is a significant market out there where people do want to talk to people. People do want
Yeah.
to take advice. People do want to know what to do with their money. And I think that's the market that we want to sort of capture. So I do think that our information, our sort of value add is advice, research, and person to speak to. And even the US, if you look at the US, I was in wealth management in the US. If you any all of my friends who worked in, say, Silicon Valley, San Francisco, where I was staying, the moment their wealth went beyond, say $500,000 or or maybe more than that, they went from going from a sort of tech-based advisor to
Right.
having an RM in the bank,
Yeah.
or a financial advisor who come and talk to them on a monthly basis. So I think wealth is very personal, and I think it does require a personal touch. And this is in the US Silicon Valley, where everybody is very futuristic, and you have a lot of these guys who invest in tech companies, but when it comes to their money,
The owned
they have
wealth.
an
Yeah.
advisor who gives them tells them what to do. So I think, and even in India, the same thing is happening. A lot of the money is now being managed by independent wealth advisors, boutique fund company just like yours. So I think wealth is still, yeah, maybe disruption in wealth will probably happen, but we don't see that happening soon. And obviously, we will be able to convert a business model as and when it happens. Today, it's working really well for us.
And finally, Pratik, before we end, right? I mean, obviously, it has been a tremendous journey for the firm over the last three and a half decades. Really stood their ground and actually not got entangled with any of the crisis and whatever sort of like comes. And there's no sort of like a very clean corporate governance, and I think that has really helped the company to uh, impart that trust. Ultimately, I think trust is something that is paramount in a financial services business, right? So that's something that has been of great care for you guys. So now, from your vantage, when you look at the next, I would say 3 decades, right? I mean, where do you think Motilal Oswal is positioned, and where do you or the management of the firm really want to take this firm to?
So I think the good thing is that innovation is in our DNA, and from the outside it may not look that way, but actually from inside, you actually we're a very innovative company. Even though we have a legacy brand, we're the first ones in the country to start an equity research desk in the early 90s. first ones to start an institutional equities desk in the late 90s, where Morgan Stanley came in and we were the first customer. First ones to launch a PMS business in 2003, where now we're one of the largest. AIFs, first ones to go sort of big in AIFs about 5 years ago, and now one of the largest. Even in ETFs, we tried to launch a big ETFs business in 2009, but then obviously the market didn't catch up. So I think, but we still kept at it, and now we're doing very well there. So I do think that innovation is big in our DNA. But as you said, I think going forward also, one of the reasons to why I'm very excited is that we'll keep on innovating in the future. We'll keep on coming up with new stuff. We'll keep on being the first ones in the industry to do things. And I think that is what we'll and so I think that's the sort of I think culture that we want to propagate in this industry, especially where things are moving so quickly. So I think that's one. Second is, I think our niche is we've kept in our niche. Most of our competitors, so our competitors change every 5-6 years. In the 90s was something else, 2000 something else. Today is discount brokers. So I think what we've really kept is we've really stayed our ground towards equities. A lot of our competitors have got into NBFCs, lending, real estate, this, that. I think we've kept focused in equities. So I think we see ourselves experts in this space, and I think for wealth creation, this is probably the best space to be. And the amount of interest that's coming, from I mean, we're still so underpenetrated. So I think next 10 years, the sort of penetration levels are going to go up maybe 10, 15, 20 times. So I think we hopefully will stand a huge chance of of making sure that we're there in every category where there's innovation. And second is in the category where we see ourselves as experts. I think those two are a good combination to have when you're looking at building a big business.
Great. Thank you so much, Pratik, for doing this for such a insightful session. I'm sure our audience and viewers today would have learned a lot from someone in your seat, having that sort of a viewpoint into really the pulse of the Indian financial industry, right? Someone who has really been there over the last 3.5 decades, has really seen the ups and downs, and for that matter, the growth of the Indian capital market. So I hope it was an insightful session for our listeners and viewers today. And we will catch you guys in the next one. Until then, stay subscribed to our podcast. Thank you.